All right, let's talk about Minerals Technologies, or MTX. They just dropped their Q2 earnings, and the market reaction was, well, pretty wild, especially for what looked like a mixed bag of results. So we're going to dig into that pop.
So right out of the gate, CEO Doug Dietrich set a really confident tone for the call. He said this was a strong quarter that positions us well to deliver a stronger second half. Basically, he's telling investors, hey, this is just the beginning. The back half of the year is where we're really going to shine.
Okay, here's how we're going to break it all down. First, the headline numbers. Then we'll get into what's behind those numbers. After that, we'll look at their guidance and the headwinds they're facing. And we'll wrap it up with our take in the next call.
All right, section 1, the headline. And really, this is all about a mixed result that got a surprisingly bullish reaction.
Okay, so this is the core of the story right here. Take a look. Revenue came in at about $529 million, which was, technically a miss, but by a hair. We're talking basically flat. But, and this is the important part, the earnings per share, the bottom line, $1.55. That didn't just beat expectations, it crushed them by almost 10%. And that right there is why the market went crazy. And when I say the market went crazy, I mean it. The stock just took off. It jumped almost 9% in after-hours trading, and by the next day's close, it was up over 10.5%. And check this out, it was on 3 times the normal trading volume. So yeah, investors sent a very clear message. We don't care about that tiny revenue miss. We love the huge earnings beat. So that brings us to the big question. How did they do it? How are they so profitable? Let's get into section 2, behind the numbers, and look at their operational strength and what's driving their growth. Yeah, this beat wasn't just some fluke. It came from good old-fashioned execution. They saw higher sales volume in both of their big segments, they got more productive, and they kept a really tight lid on costs. The result? Look at that operating margin. It jumped 200 basis points from the last quarter, all the way up to nearly 15%. Oh, and they also cranked out almost $34 million in free cash flow. This is a company that's firing on all cylinders operationally. Now, to really get MTX, you have to understand their PCC satellite projects. It's a huge part of their strategy. So what is it? It's actually pretty brilliant. Instead of making this stuff, precipitated calcium carbonate, in a big central factory, they literally build a small plant right there on site at their customer's location. This means they can tailor the product specifically for that customer, and the logistics are just unbeatable. It's the core of how they plan to grow. And this is why that strategy is so important right now. Look at this pipeline of projects they have coming up. Later this quarter, a new pet litter facility in Asia opens its doors. Then, over the next 7 or 8 months, we're getting 3 new PCC satellites plus an expansion, mostly in India and China. And then the big one, early 2026, they've got a major project for sustainable aviation fuel purification products coming online. All told, management says these projects are going to add around $100 million in new revenue, and importantly, it's higher margin revenue. And just so you have a quick picture of the company, here's the sales breakdown. It's almost a 50-50 split between their consumer and specialties side and their engineered solutions side. But one little detail to keep in mind, that engineered solutions segment was the real profitability engine this quarter, pulling in a super strong 17.4% operating margin.
Okay, let's move on to section 3, guidance and headwinds. So, what's the outlook? Well, it's a classic case of cautious optimism.
So for the next quarter, Q3, here's what they're officially guiding for. Sales somewhere in the ballpark of $525 to $535 million, and operating income right around $75 million. So pretty much flat compared to this quarter. But the real key here is that management kept hammering this point home. They really believe the second half of the year will be stronger overall than the first half. But it's not all smooth sailing. Management was very clear about the #1 headwind they're watching, tariff uncertainty. In fact, they're already bracing for a $1.5 million hit to their costs in Q3 just from this. And tariffs aren't the only thing on their radar. There's a whole list of other macro risks. You've got soft steel and paper markets over in Europe. Here in North America, the cat litter market is slowing down because competitors are running all these crazy promotions. Higher interest rates are hitting commercial construction. And then there's the talc litigation, which is kind of always humming in the background, even though they have money set aside for it. And just to double-click on that steel market point for a second, the difference between regions is night and day. North America, things are looking pretty stable. Plants are running at about 78% capacity. But Europe, it's a totally different story. The market is weak, and management basically said, don't expect that to change anytime soon. Okay, time to put it all together. Section 4, the next call. This is where we give you our take on MTX and what it all means. So, the big question. After all that, what's the call on MTX? All right, here's our prediction. For Q3, we think they'll hit their numbers, pretty much in line with guidance. We see the stock probably trading sideways for a bit, kind of range-bound, while everyone waits for those new growth projects to kick in. So our rating, we're calling it an outperform. And the reasoning is simple. 1, their margin discipline is just fantastic. 2, their balance sheet is rock solid with net leverage at only 1.7x. And 3, they have a crystal clear path to growth with that project pipeline we talked about.
So how would you play this? Here's a potential trade idea. First, the entry. We'd look to buy shares on any dips caused by bad macro news, accumulate on weakness. Second, the target. We're aiming for that $84 analyst price target over the next year. Third, the catalysts to watch for. Keep a close eye on the execution of those PCC satellite startups in Asia. That's key. And finally, the risk. What could go wrong? Well, if those projects ramp up slower than expected, or if those tariffs end up being a much bigger deal than they think.
And that really boils it all down to one final question, doesn't it? Can MTX's incredible operational skill keep winning against all these stubborn macro headwinds? That's the real battle here, and that's the story we'll be watching.
All right, that's our deep dive on minerals technologies. Thanks for tuning in, and of course, just a reminder, this is not financial advice.